Good morning. You're watching the market right here in ET Now and flat for the week. That's how we turned out to be. Kick-started earnings full hog and US markets though, they continue their outperformance. So for the week gone by, we managed to eke out a gain of about 2%. It's been all about earnings. This morning, we're going to react to, I don't know which one first, Reliance, Kotak, ICICI Bank.
I think the reaction will not be there. It is just one of those phases of the market that we are in middle of the news flow. We are about 10 days away from the budget. A lot happening at the global front, but markets are jumping in the same place. Yeah. The bulls would say this is consolidation. The bears would say the markets are showing you signs of topping out. Bottom line here is that everyone is confused. It's just one of the zones in the market. I'm using the word zone on purpose. Our viewers will understand when I say the word zone. It's just one of the zones in the market where you have to realize that markets are not headed anywhere. They're waiting for a breakout or a breakdown or a definitive call. We'll talk about it, but my sense is budget is that trigger point. And it's all about LTCG. So everybody who wants to trade long is waiting for the budget, and everybody who has got cash on the sideline is saying it is better to come late rather than trying to preempt what is coming next.
Yeah, fortunately for today, we have a decent set of cues. At least the US handover has been strong. Yes, the budget is going to be one of the key triggers. Also remember, not just that we're going to be in the penultimate week to the budget, we'll also have F&O expiry. So that's also going to be critical. And just looking at the FII, DII picture, and clearly FIIs have been on the back foot. Month to date, we've seen a mammoth sell-off of $1.85 billion already.
Yeah, and Aisha, that's the irony that, for a market where the positioning is perhaps so clear that India is on a growth track, it will continue to do better than what others are doing. The general positioning of the FIs is that, look, India has outperformed, we know that, but India is expensive. The scope of other markets which were bombed out for 2022, they are the ones who will give you higher returns, whether it is a combination of buying emerging markets like Brazil and Taiwan or going all in China. So it's not that flows are bad into emerging markets, it's just that Indian markets are not getting flows. Taiwan is up. Yeah. Flows are strong. Brazil is up, flows are strong. India is underperforming, a word which you've not used for a long time. I think now it's official that in the initial 3 weeks, flows are moving back to other markets. India is not a large recipient of the flows. US markets are doing rather well for themselves, and Indian markets are underperforming.
Yes, indeed, and perhaps that China reopening is one of the triggers for the same. It's counting down to the budget, and as we do that, we're also in the thick of the earnings season, so lots of numbers coming out. Of course, as usual, it was a late evening on Friday as Reliance Industries came out with its quarterly performance pretty much in line with what the street was expecting, and then a bank-heavy earnings day on Saturday. ICICI Bank, for instance, Kotak Bank came out with a pretty healthy set of numbers, and you also had Ultratech, which was another heavyweight, which came out with its numbers in line with street expectations. Nikunj, just purely looking at Reliance Industries and what they delivered, because the street was hinging a lot on this after a spate of maybe flattish underperformance. Your verdict and a view on the bank's numbers.
So Reliance numbers are absolutely in line. So the Jio growth is slowing down, but the upside what they're getting in the O2 business, the old economy business of this, I think is great. Similarly, retail continues to grow. But looking at the tone and the tonality of the management commentary and the fact that the debt levels in Reliance are going higher, markets know that Reliance now is on a new capex cycle. And typically when Reliance is in beginning of a new capex cycle, the stock tends to underperform, and I think it is empirically evident the way how post the AGM the stock is underperformed. So I don't see a change in positioning based on these numbers from Reliance Industries. Debt is going higher. The Jio business I think is not growing, but other businesses are growing. So these numbers will not really excite brokerages to upgrade their target. So that has not happened, and these numbers are unlikely to fuel any kind of an optimism into Reliance as a stock now. Reliance price action in the short term will be a pure function of how flows would move because it's a heavyweight stock. So depending on what the ETF allocations are, I think that is the way I think Reliance stock would move.
History of a decade-long consolidation also. There have been the past few decades where Reliance as a stock has done nothing, and then suddenly that spurt up comes like we had in 2020.
Yeah, so what is that phase? That phase is that when Reliance is on the cusp of a capex cycle, the stock tends to underperform.
Yeah.
So Reliance, when they were on the cusp of the Jio capex cycle, it underperformed. But when the Jio capex was over, it really went higher. Similarly, right now they are on the cusp of their new hydrogen capex cycle. So that explains that I think in the near term, Reliance at best, because it has underperformed and it's a heavyweight, I think it would be a market performer to a market mild underperformer. But numbers are unlikely to re-rate the stock. Then you got ICICI Bank and Kotak Bank. Within ICICI Bank, the numbers are solid, but the deposit growth is not there, which means there would be pressure on the NIMs going forward. If you're getting less deposit, you will have to lend less, or you will have to acquire deposit at a higher rate, which means pressure on margins. Numbers in terms of the line items, I think they're absolutely great. But ICICI Bank has been an outperforming stock. And the price targets for ICICI Bank are way above what the current price is. So that's the reason why the outperformance, that's the reason why upgrades are not happening. The dark horse is Kotak, a beat on all account. Solid CASA, solid deposit growth. Stock has underperformed. And Kotak Mahindra Bank has not done anything in last 1 year. Let's compare that. Let's compare ICICI Bank with Kotak Mahindra Bank last 1 year. And then it's easy to understand. And based on numbers, if I have to pull out one number where one company or one bank where there is scope of outperformance, there you see. Look at that's ICICI Bank for you. It's up 9%, Kotak is down 3%. That's a delta of about 12%. And I think the scope of outperformance based on the numbers, I think, is there in Kotak rather than ICICI Bank, because ICICI Bank is well discovered, well owned, well debated, over-owned and over-discussed even in television studios.
Yeah, absolutely. So let's see a bigger reaction perhaps on Kotak Bank. But penultimate week to the budget, of course, there'll be F&O expiry, so that is also going to keep the markets fairly volatile, unlike the flat move that they've been off late. But, just looking at historically, Nikunj, while we debate how critical is budget really, considering a large sensitive info like the rates or interest rates are already out of it with the GST now. But I was just looking at the historical data on budget. Last budget, you had a 2.25% move only on the Nifty. 2021, you had a 5% move. So you can't shun the budget as a non-event. And especially with all the talk around LTCG, it sure is going to be a big factor.
So, last three budgets have been very different. You had the 2021 budget immediately after COVID, and that really turned out to be the turning point from the market in terms of where government wants to take the balance sheet. So that re-rated the whole appeal of government in terms of managing and growing, and that re-rated the market. 2022, I think, was extension of the good work which was done in 2021. Nothing draconian, very clear, simple taxes, commitment towards fiscal management. Everything was great. Now is the test, because the economy does not need that kind of a multiplier effect. We are doing rather well. But can this budget really, like our phase is, can this budget really take India to a different leap? So in terms of an ideology, what that budget would be. Now let's look at market. Whether we like it or we don't like it, every second narrative in the market is centered around LTCG. Tarun Bajaj, before he retired as a revenue secretary, he gave a hint that Indian taxation structure have to be simplified. In India, the taxation structure is very different. LTCG rates are different, STG rates are different. You've got an STT, there's an indexation for debt fund, different for real estate, different for equity. Will that be simplified? Which is that, will the lower tax go higher? That's bad news. Because in India, higher tax will never come lower.
Yeah.
So the debate is whether the lower tax will go higher. If that happens, that's bad news.
Yeah.
So that in a sense becomes this entire big watchword from this year's budget, and I think the market reaction would be centered around what will happen in the short term at least. My sense is nothing should happen. Why would the government like to shake the apple cart when they are getting everything right? But you never know what's there on their mind.
Okay, countdown on to 1st of February and budget. The big thinking, of course, be why will you disrupt one of the best performing capital markets on this planet with a tweak in the capital gains tax? The HNIs and ultra HNIs hoping that maybe the Central Exchequer, Nirmala Sitharaman, will have a second mind as far as the super rich tax goes. Remember, that was supposed to be withdrawn at the 75th year, but then stayed because of COVID. Let's see what happens. Best of analysis right here on ET Now. Well, with that, back to the markets. And we recently hosted Saurabh Mukherjee of Marcellus and asked him where is he seeing the pockets of growth when it comes to 2023 and the rationale for adding Tata Elxsi to the portfolio as Relaxo Footwear makes an exit. Listen in.
bearish on IT services. It's like being bearish on steam engines at the heart of the industrial revolution. So I think this time around, I think fairly convincingly, not just TCS, but also Infosys, even HCL Tech, the results quite convincingly show that regardless of what happens to GDP growth in the Western world, the migration to cloud, outsourcing to India, these are incredibly powerful themes that will power through an economic slowdown, and that sort of reinforces our faith, which is why at one level actually in our mid cap portfolio in Rising Giants, we've gone ahead and added Tata Elxsi. So over and above L&T Technology Services, which was already our existing engineering R&D play, we've added another engineering R&D play, Tata Elxsi, similar sort of drivers. The West needs more Indian help for engineering, for research and development. They don't have that many STEM graduates. We have more STEM graduates. We have high quality companies with great pedigree. So I think this area is something we'll keep looking to build on. A decadal 10-year surge in Western intellect-related work migrating to India. The area where we're a little circumspect, and you could see that, say, both in Asian Paints' results and also even Havells' results. We don't hold Havells, but I think Air Electrical, it's a good benchmark to observe. There's a degree of top line softness in Asian Paints' case after, I think, 3 years of blistering top line growth, where I think they CAGR'd at 17%. You had a soft quarter on the top line, but thankfully it's made up by the fact that you've seen EBITDA margins recovering as the global commodity wave ebbs. Asian Paints, I think, saw a 400 bps jump in EBITDA margins.
Hi, my name is Shashank Shrivastava. I am from Maruti Suzuki, and I'll be taking a close look at the forthcoming union budget from the auto industry perspective. Auto industry, as you know, has had 3 really tough years, and in fact the last year was actually good from a volume perspective, but the challenges continue. So I'll be talking about the expectations from the industry regarding how to make growth a reality for this industry. So tune in to ET Now as I decode the union budget from an auto industry perspective.
Okay, so as you can see, an action-packed show lined up for you all the way till 11 a.m. For now, it's time to touch base with the chartists and figure out the index levels to watch out for, get you stock-specific money-making ideas as well. Naresh Marani here with us. Good morning, Naresh. If we look at the SGX Nifty, certainly indicating a positive start. We've had big earnings declared since closing bell on Friday as well. What are the levels that you're watching out for when we talk about the indices? And of course, as always, a special word on the Bank Nifty.
So continue to be in the same range wherein 18,200 remains a major problem for the Nifty. Expecting this range to continue on the Nifty as well. For now, 18,200 will be a resistance. Overall, 17,800 has become base. And I think going into the budget, we may find it tougher to cross this 18,200, 250. And post that, maybe we can see more clarity. Same way on the Bank Nifty, we've not been able to cross the 42,600 mark, which is an extreme short-term resistance. But overall, 43,200 next is what I would expect. And that would be a tough one to cross. So I would expect this one to go towards 43,000. Expect a little bit of outperformance from the Bank Nifty over the next few sessions.
All right, that's the view coming in, getting in a take on the overall market setup. Naresh, let's get in your top recommendations as well. You continue to bet on heavyweights within the energy space.
Yeah, so continue like oil and gas space as the next rotation, and the PSU segment to be the most interesting one going forward. So first is a buy on ONGC. The stock has made three tops around that 150 mark, and also has started showing a strong uptrend after a really long period of time. So expecting this to continue in the short term, a target at 170 and a stop loss at 146. Second is a buy on GAIL India, which has made a very strong base around that 80-85 mark. In the near term, 9900 is a resistance which I tried to cross on Friday. Expect a quick move towards 110, a stop loss at 96.
Okay, let's move on and let's dissect all the earnings that we have at our hands this Monday morning. And Big Boy Reliance came out with its Q3 results on Friday, and the numbers are in line with estimates. But there's more to that. Let me take it across to Somit and find out what the details and the lowdown for the numbers are. Somit?
Well, if you see compared to the street estimates, the revenue and net profit is pretty much in line, but the big beat for Reliance Industries has come in on the EBITDA front. Now, street was expecting the EBITDA number to be close to 33,700 crore rupees, but the company has reported an EBITDA of close to 35,247 crore rupees. So this big beat has naturally come in from the O2C segment, because there the number has grown around 16% on a sequential basis, and the O2C segment's EBITDA is close to 13,900 crore rupees. Now, this is on the back of the fact that in the third quarter of FY23, the export tax was removed from SEZ, that is a special economic zone where Reliance Industries has one of its refinery unit, and also on a relative basis, if you see, the impact of windfall tax was lower in the third quarter of FY23. Now, moving on to the other segment, that is the retail segment, the performance is pretty much in line with what the street was expecting. Retail EBITDA is higher by around 7%, and that is what the street was expecting. And the biggest growth, or the sequential growth, has come in from the oil and gas exploration segment, and that is purely on the back of higher production and higher gas prices in the third quarter. We have seen a sequential growth of close to 22% when it comes to the gas exploration business. And lastly, when it comes to Geo numbers, we have seen a marginal miss coming in on the EBITDA front, and that is because the ARPU number for Reliance Geo has also come in slightly below than what the street was expecting. Street was expecting the ARPU number to be close to 179.6, but the company has reported an ARPU of 178 rupees per user per month. Now, to sum it up the result, the O2C segment was a beat. Retail, oil and gas exploration was in line with what street estimates. Geo was a marginal miss, but the overall numbers on the EBITDA front looks a good 5% beat compared to what the street was expecting.
Okay, so watch out for Reliance Industries at opening bell. We've had enough time to analyze the numbers, digest it. Thanks a lot, Samit, for that. Let's stay with the big earnings that came out since closing bell on Friday. You've got two bank counters, ICICI as well as Kotak, to watch out for. ICICI, once again, delivering on all parameters, but it's Kotak that has actually beaten estimates and the ET Now poll as well. Harsh joining in with that. Good morning, Harsh.
Well, good morning. Largely in-line set of numbers from ICICI. Let's look at what brokerages have to say. CLSA continues to maintain a buy on ICICI. 1175 is their target price. Solid upside there. What they're suggesting is that results keep getting better each time we are looking at them as each quarter passes. The other piece that they're also suggesting is valuations are getting and looking more attractive and getting better. What they're also suggesting is robust growth continues for ICICI Bank. The NIM spike also continues, which is a couple of positives there. And operating profit has jumped, which is also a definite positive. In terms of what Jefferies looks at ICICI Bank at, as they're given it a target price of 1150 a share, the NIM expansion is what is leading to NII growth. And of course, the loan book expansion as well. The fee drag, they believe, is partly reflected of the change in approach that ICICI Bank is adopting. Asset quality is strong and conservative provisioning is a positive. They're raising earnings estimates by 5 to 7% going forward. Bernstein also has a buy target price. In fact, at 1,000 rupees a share, they are saying that the margin expansion is what is leading to the beat in earnings, at least for them. There is a moderation in expense growth that has happened, which is a positive. They are expecting to continue to see healthy credit growth going forward and sharp margin expansion going forward as well. So a healthy set of numbers is how Bernstein summarizes ICICI Bank. Let's quickly go in and have a listen in on what the management of ICICI Bank had to say.
At ICICI Bank, we aim to grow our core operating profit in a risk-calibrated manner through a 360-degree customer-centric approach and by focusing on ecosystems and micro markets. We continue to operate within our strategic framework and strengthen our franchise, enhance our delivery and servicing capabilities. During the quarter, we have revised our provisioning norms on non-performing assets to make them more conservative for corporate, SME and business banking. These changes resulted in higher provisions amounting to rupees 1,196 crore rupees in the quarter. Going forward, we will continue to operate within our strategic framework while focusing on micro markets and ecosystems. The principles of fair to customer, fair to bank, and one bank, one team, one ROE will guide all our operations. We will be focusing on a risk-calibrated growth. It can come from retail, SME, corporate, wholesale, rural, all parts of the economy. Yes, SME being a little, has been growing at a much more healthier pace at this point of time, which is sort of a fact. In fact, during the quarter, our SME portfolio grew by about 25% and our business banking grew by 37.9% year on year.
Well, yes, we'll go straight to Kotak here. What Jeffrey suggests is they've maintained a buy of 2470 a share. They believe that Kotak has ticked most boxes on the earnings front, so definitely a positive. Strong loan growth is led largely by unsecured as they continue to expand that unsecured pie. They're expecting growth in savings account going forward, but it's disappointing this time around. They've raised their earnings estimate by around 3 to 7%. Valuations is, of course, at a premium to peers. CLSA also maintains an outperform, target price 2,080 a share. They believe that valuations are finally getting a little bit reasonable. Retail deposit accretion has happened. Growth is robust and they're expecting 20% plus loan growth CAGR going forward, and higher OPEX and investment is set to continue. ICICI Direct also has a buy with a target price of 2450. So definitely giving Kotak a thumbs up. Let's quickly listen in to what the management had to say on the results.
At the overall consolidated level again, our capital adequacy continuing to be healthy with CET1 at 22.3% overall numbers. Our ROA continued to be at 2.7% if I take this quarter and annualize it. The book value per share at 540 overall. And the subsidiaries, we've seen the two NBFCs, which is KMP, growing its vehicle finance business 24% on a YOY basis, whereas the Kotak Mahindra Investments saw a sharp tick in this quarter with the advances going up about 16% on a quarter-on-quarter basis. Both the entities having curtailed NPAs as well as pretty decent capital adequacy at 30% or thereabouts for both of them.
All right, let's also connect with Rahul Malani, who's joining in. He's banking analyst at Sharekhan to discuss all the numbers in greater detail. Now, Rahul, let's begin by talking about ICICI Bank's numbers in greater detail. All in all, it was a fairly decent quarter in line with street expectations is how we're categorizing it. But you had the deposit growth, which came in as a bit of a lag. Is that going to be a bit of a concern?
So, first of all, good morning. The overall numbers looks good. They were above estimates, but mainly the beat was due to the higher NIMs expansion. And which was and also if you look at they have scaled up the contingent provisions, which was a key positive. In terms of key negative, you have highlighted that there was the deposit mobilization moderated bit on YOY basis as well as in quarter-on-quarter basis. So key monitorable going forward should be the deposit mobilization and also the operating leverage, because the bank has given strong outperformance in the recent years. and further re-rating is unlikely if the growth moderates from here in coming quarters. Because if we look at the credit deposit ratios also, it is hovering at the higher end of the channel. So key monitorable here would be around deposit mobilizations.
Rahul Malani, good morning. So, but for all the numbers that we have from the private sector banks, can I ask you, what are you folks at BNP Paribas now talking about when it comes to which of these banks can have the next significant upside in the stock markets? We've talked a lot about the ICICI Bank leadership. We've been waiting for the elephants to dance, which are the HDFC twins. It has started to happen. And one should remember that in the run-up to this earnings season, what you'd really seen was a lot of action for the public sector banks' share price. But now, post the results, a re-rating for which ones?
So basically, from 1 to 2 years perspective, in the last 2 years or 3 year cycles, we have seen ICICI Bank outperforming in terms of private banks. So in next 2 years cycles, we believe that SDFC Bank and Kotak Bank will be the outperformer. Once the smooth transitions and the dispensations are received from the RBI, you would see certainly the re-rating happening in the SDFC Bank also. In Kotak Bank also, earning trajectory continues to remain a bit. If we look at near-term focus would be on the transition of Mr. Uday Kotak, who would be retiring. Once it is out, you will see stock outperformance because they both have underperformed in the last 2 to 3 years time frame. So we believe that you will get market returns in terms of ICICI Bank, but outperformance is unlikely going forward in ICICI Bank. In terms of PSU banks also, the same is that top tier in top tier PSUs you will get market returns, but you will get outperformance in the in the lower end of the PSU banks like Punjab National Bank, Bank of India, etc.
Okay, thanks very much, Rahul, for giving us your take on the earnings within the banking space. Rajesh Palve as well joining in on the technical side. Rajesh, hi there. Good morning. It's expiry week. What is it that you're working with by way of levels on the index, given the fact that we've been circling around in a very tight range, as well as ahead of the big budget run-up event? And share with us some of your top trades.
Yeah, good morning. So definitely it's a fifth week where we stuck in the range of 17,700 to 18,300 for Nifty. And again, Nifty is, failed to cross this resistance area since last 4 5 weeks. So looking at the overall scenario and especially in last 3 4 trading session, what we have seen that, Nifty is now comfortably trading above 18,000 level after the recovery from recent low. And looking at the rollover activity also, we feel that some more upside momentum we can see towards this expiry week as well as ahead of budget. We are projecting Nifty target towards 18,180 to 18,200 in the continuation of this pullback which we have observed, especially in last week. Overall setup is looking promising for this week. Till we are holding above 17,960, 970 zone, trend is likely to remain on the bullish side. So one can buy any dips towards 18,000 level with stop loss of 17,970, upside target 18,180, 18,200. On the other hand, Bank Nifty is looking very interesting. Almost it's now trading near to its immediate resistance area of 42,600, 700, which is acting as a resistance area. But looking at the component of Bank Nifty, we feel that, if at all Bank Nifty manages to cross above 42,600, 650 zone, then there is one round of short covering we can expect in current week. As most of the call writers have created their position around those strikes. So if at all we crosses those level, then one round of short covering we can expect in Bank Nifty, and then possibly Bank Nifty can move further higher towards 42,800, 43,000 level also. So buy on dips is the strategy for Bank Nifty also. One can keep a stop loss of 42,200 to remain long in the Bank Nifty also. Moving to the stock specific, we feel that Dabur can be looked at the current market price. In the previous trading session, a strong buying action has been seen. Stock now trading about 20-day moving average, almost approaching to 50-day moving average. Looking at the traction in especially in FMCG sector, we feel that Dabur can be outperformed. One can place a stop loss of 555 to go long in Dabur for upside target of 580. Another stock from mid cap space, that is APL Apollo. very strong buying action throughout the week in the last week, and now stock is approaching to its previous swing high level. And looking at the overall setup for APL Apollo Tubes, we believe that this momentum is likely to continue further. And upside target we are projecting around 1260 to 1280. One can buy. In the decline also keep stop loss of 1155.
Okay, hang in there. So those are the top ideas we've gotten, and we continue to get for our viewers money-making stock-specific ideas. Here's Himang Jani with his list.
There are investors who are looking out for some stable, companies with a good revenue visibility on a consistent basis. So while these stocks have run up, I think, given the increased defense spend and the higher visibility of revenue, people would really want to have a pie of that. And from that perspective, I think two names we like. One is Bharat Electronics, the other one is HAL. We do not cover some of the shipbuilders and many other categories which are there as a part of the defense ecosystem. But I definitely think that it makes sense to have some allocation to the defense theme given the very strong revenue visibility and the increased focus.
Straight on then, Vibha Padalkar is joining in, MD and CEO HDFC Life Insurance, to talk about the quarterly performance, and let's connect with her. Thank you so much for taking time out. Now, to begin with, your product mix has seen a sharp shift towards better margin products, including non-par. But margins, on a year-on-year basis, they've been flat. So how does one look at the mix?
You have to deconstruct this, wherein the margins that you see now are at a consolidated level post merger with Exide Life. So standalone margins, they have gone up, and by that I mean just HDFC Life and Exide Life's margins that were at high single digits is what we mentioned just before the merger. And that has got subsumed. So actually we've reached a level of margin neutrality faster than what we had originally anticipated in terms of time that it would take. And to explain that, we have reached a margin of 26.5% on a 9-month basis, which is exactly the margin that was there 9 months of last year on a standalone basis. And so the synergy extraction process has started. And when you mentioned that the margins are flat, if you were to look at standalone margins for Q3, that has been 26.8%. And so that this is demonstrating a smooth upward curve on margins.
So can I ask you, and even though however obvious it sounds, for the benefit of our viewers, will the product mix therefore continue to move towards the higher margins going forward? How deliberate has the strategy been?
We believe in a balanced product mix as well as balanced distribution mix. And we run our product choices at a suitability for the customer as well as what is the cost of acquisition at a channel level. So you will see pretty similar levels of product mix, wherein we have said that non-par will be about 30 to 35% thereabouts. And you will find that unit link to be about 20 to 25%, participating products to be about 30 to 33%, and the rest will be a combination of annuity and protection products. You'll find very similar kind of a breakup in the year ahead.
So in terms of OPEX, is there likely an improvement in going forward as efficiencies with Exide Life as well will be kicking in?
Absolutely. And you'll find that looking at OPEX will not really give the correct picture. Reason is that Indian GAAP does not allow straight lining of costs as you incur. And we sell long tenured policies typically. So supposing we were to sell a 10-year policy, a large chunk of what we incur in acquiring that policy is upfront in year one. And that will be booked as OPEX in the year in which we incur it, very similar to like cash accounting. However, the benefits of that policy will accrue over the next 10 years, assuming that the policyholder continues to pay their premiums. And so the other way of looking at this is in terms of new business margins. And that would show that are we writing profitable business?
Something else to talk about is, the agency channel that has seen a sharp shift in terms of the distribution mix. Can you share with us how much you would say is attributable to the agents?
It's a combination. Both companies have done well on agency channel. Our standalone, meaning pre-merger avatar of HDFC Life, has grown 2x in terms of versus company level growth, and the erstwhile Exide Life also has done well. And as a combination, from being about 14% of our business, agency channel now contributes about 18% of our individual business. This is a stated objective that our agency as well as proprietary channel will start becoming more and more meaningful over the next 2 to 3 years. So we're well on track for that.
Good to know. And, finally, HDFC Life has in the past expressed keenness in entering the health insurance space. Now that the IRDAI has given, life insurers this opportunity, is this now being actively considered? How quickly? And we've also got the upcoming merger. So could it be a possibility of a merger maybe with HDFC Ergo?
See, as the regulatory construct today, there is no question of us filing for anything in terms of whether it is health or any general insurance. Having said that, you will recall that back in time, HDFC Life, along with a lot of our peers, did show interest in also being able to sell health indemnity, especially in the context of having new products. Thereafter, a committee was formed. I was part of that committee. A report was submitted about 18 odd months, if not more, back. And thereafter, I chaired the Development and Penetration Committee, and that report was filed, in which again we sought being allowed to do health indemnity. So all of that shows that there is interest, but I think we'll have to see in what form or shape there is regulatory facilitation for us to take a call. Another thought process is that we don't have to manufacture everything. There are some core competences that we have. We can be in partnerships. We already work very closely with HDFC Ergo, and we do have a combination product which is doing very well. They have an Optima secure product, and along with ours, Click to Protect Avatar, so doing well. So we'll do more of that. So there are various models that can emerge. The intention here is that how do we expand the pie? How do we have more product innovation? How do we make it easier for the customer? Today the customer to buy Mediclaim has to go there, to buy cancer care goes somewhere else, health saving is somewhere else, overseas medical is somewhere else. So how do we make it easier? I think those are the aspects that really consume us.
Okay, Vibha, we're going to leave it at that. Thank you so much for joining us today and dissecting the earnings as well, what to watch out for HDFC Life. Currently, the stock, for the last 1 year has given a negative return of 5.5%. With that, Naresh, I'd like to come to you. And, we've just heard from the top management of HDFC Life, but it's actually the HDFC Bank that I wanted to talk to you about. We've seen the earnings that have also come out, and we've now seen the private sector lenders come out with their numbers. And the question, Naresh, is can HDFC Bank in 2023 be what ITC was in 2022? We've been waiting for this elephant to dance, and it started to.
So the difference is when we go to ITC, it was FII selling which led to the bottom, and once the FIIs became buyers, the trend changed. The problem with HDFC Bank is it's an event which has been a concern for a long period of time. So if you look at the price action over the last 2 years, the stock topped out at 1600 in 1640 in 2021 Jan. That is where most of the banking and financials topped out. Post that, it made a recovery to 1700 plus levels in October 21. Fell all the way down to 1300 in February, March 22. Then we saw this big event announcement, and again we topped out around 1720. Over the last 3-4 months, we've made a top around 1650, 1670. So technically, if we can sustain about 1700, it could be a stock which could go towards 2000 also. So this could be the stock which could decide the whole trend for the Nifty and the Bank Nifty, given that it has a weight of, say, if you could keep a combined weight of HDFC Twins, that's a weight of 16 to 18% on the Nifty. And on the Bank Nifty, 27% weight as of now only when there is HDFC Bank. And going forward, if the both merge and it becomes a part of Bank Nifty, it would be much higher. So technically, we are shaping for that eventual breakout above that 1700 mark. When it happens, whether it happens post an event or we keep seeing a slow updrift is a difficult call. But overall, technically, we've made a base around 1550 to 1550 levels. So it's a buy on dips going forward. If one has a contrarian view, it could be the surprise pack for the next 1 year, maybe even 1.5 year.
Right, okay. Adani Enterprises, the top boss, Gautam Adani, shared the intent behind the company's 20,000 crore rupee FPO. He says the intent of the FPO is to bring in new public equity. Hear out what he had to say.
Our FPO comes at a unique point of time, a time when we are at our strongest, with most of our growth is still ahead of us. This Adani Enterprises FPO is a part of our 10-year capital planning cycle, supported by a fully funded and a de-risked growth plan that is aligned with the India's growth story, aligned with our capabilities, and aligned with the needs of our India's retail shareholders. Our intention with the FPO is to expand our share registry with a specific focus on our India's retail investors. The FPO is a validation of our intent to bring in new public equity investors as our shareholders. I welcome new investors to come and join our extended shareholder family.
All right, Gautam Adani, they're talking about the intent of the FPO. Let's get a move on then. Lots of stocks on our radar, but we've got two on the editor's radar. They're both brokerage notes, so let's get straight to it by discussing Bharti Airtel first up. That's the stock that we're pointing out. Now, Morgan Stanley has come out with their latest research note. They're saying that it's a good opportunity to buy the stock on dips, and they maintain an overweight rating. They've got a target price of about 860 rupees thereabouts. And Nikunj, just looking at what we've seen pan out for a Bharti Airtel so far, they've said that it's a good defensive name to have in the portfolio. It's definitely a must, right?
The stock has corrected. So when we spotted the stock, of course, it was north of 800, and from there it has come down almost to 750, 760. One thing is clear that 5G is not going to be as bumper as what everybody thought. But Bharti, given its positioning that worst of the price war is behind us, ARPU directionally they should go higher. Reliance Jio, the numbers from Reliance Jio are looking weak. So it is not that the entire telecom sector is contracting. Reliance Jio, the high bumper market growth gain era, I think is behind us, and that is where I think Bharti would benefit. The macros are also very challenging, and they will remain challenging for this year, whether it is on inflation or recession. Typically, that's the time defensive stocks outperform. So this will qualify as a stock where you would say, I cannot buy it for a 30% gain, but I may want to buy this stock in my portfolio more like an hedge, more like a stock which should fall less, given how the contours globally are going to be challenging, and locally also 5G rollout, well, it's going to cost upfront and benefits later. But frankly, after the Jio numbers, there is hope that worst is clearly behind Bharti.
Okay, absolutely muted. That's a 3-month chart, down about 4.7% on Bharti Airtel. Let's get a move on then and discuss the next stock on the editor's radar, and that's IDFC First Bank. CLSA in their latest note has upgraded the stock. They believe that post the Q3, it's a compelling buy recommendation, and they've got a target price at 75 rupees. They've also spoken about how the core PPOP growth is forecast at about 33%. They're seeing liability traction as well for the stock going forward. Your views?
You typically want to look at mid-tier banks which have ability to garner great CASA. They are giving rates which are higher than the industry average in terms of fixed deposits, so the CASA is actually strong. But that in hindsight actually benefited a franchise like IDFC Bank. Second, being a small bank, the ability to grow is certainly much higher than the industry average. And now hopefully that overhang of IDFC Limited and IDFC Bank merger will go through. It's not happened. It was expected to happen last quarter. It has not happened. Small bank, not very expensive, decent CASA growth and ability to grow, and the trigger really could be the merger between the bank and IDFC Bank. So net it's a stock from the mid cap banking space which you would say could be an outperforming stock. Even though it has outperformed, I think it has these contours of an outperformance still left.
Okay, contours of an outperformance still remaining for IDFC First Bank. There you go, Nayantara. Those are the stocks on the editor's radar.
Okay, so stocks on the editor's radar there. Watch out for all of them, and now you know why too. Sandeep Sabharwal is here with us. Good morning, Sandeep. Should we begin with the big earnings that came out on Friday post-closing bell, and what you made of them? Reliance Industries.
So Reliance results per se were perfectly fine, like in terms of the operating profit margin, delivery, and performance across the businesses. Geo was slightly slow, but then that's fine. That was expected. The two points which keeps the valuations down is one, the debt levels again are increasing rapidly with huge capex reported in this quarter, also around 38,000 crores. Net debt has gone up to 1,13,000 crores. Interest costs went up sharply as a result in this quarter. And this is despite none of the new businesses they have announced investment into hydrogen, etc. Actually kicking off. So I think that keeps the valuation down for Reliance. They had a target of zero net debt. So that doesn't seem to be either possible or imminent right now.
Right. Sandeep, hi, morning. That's that on Reliance, but it's going to be a tough battle between ICICI Bank and Kotak, I think. You think Kotak would impress the street more, considering the consensus ICICI Bank already is?
You could be right, because simply because of the fact that Kotak Bank has underperformed so much in the recent past, mainly due to valuation concerns. Those valuation concerns haven't gone away. Like in terms of valuations, it still is expensive relative to both HDFC Bank and ICICI Bank at a time when most growth parameters for all banks are virtually similar. So I would think that Kotak Bank results are good, its value of subsidiaries expanded, but it's still more expensive than the other banks. ICICI Bank results, it was difficult to find out anything negative except for the lower deposit growth vis-a-vis credit growth. And as they try to gain more deposits, how that impacts their margins, that's something we need to see. The most positive thing about, I think, ICICI Bank is their contingency reserves. So they have built up contingency reserves of 11,500 crores, while their net NPA is just 5,500 odd crores. So effectively, they are at zero net NPAs, which is an exceptional performance, and their provision coverage ratio at 82% is the highest in the banking industry. So my guess is that, and it's still 20-25% cheaper than HDFC Bank. My guess is it will continue to be one of the better performing banking stocks over the next 2-3 years.
Okay, that's the view coming in. Let's discuss it on the charts then. And Naresh, ICICI Bank versus Kotak.
It's a tough call given that ICICI Bank has been an outperformer for the last couple of years, but Kotak Mahindra Bank has been a terrible underperformer. Say the stock price is available at the same price where it was pre-COVID almost. So pre-COVID the stock was at 1700 and now we are at 1760 roughly. If you go to ICICI Bank pre-COVID, it used to be 500, 550, and today we are at 870. So it's a tough call, but technically the way to look at it is we continue to believe the outperformers till the time it continues to do so. As of now, we see Kotak Mahindra Bank still at the 52-week lows. So once it starts recovering, that is the point of time I would change the track. As of now, I would expect ICICI Bank to do better in the short term as well as the medium term.
Okay, so that's why you've got the banks very much in focus. And Sandeep, let's ask you about this, the big beat that we've seen from Kotak Mahindra Bank. Till now, so much has been said about ICICI Bank and has been the preferred private sector lender in that sense to bet on. Can that change? Is it now the turn of Kotak?
So in the near term, it's very tough to predict, but I think longer term, Kotak Bank still trades at a significant valuation premium to both HDFC Bank and ICICI Bank, and there's no reason for that premium to actually exist because the phase where these some of the banks were smaller and they were growing much more rapidly than the bigger banks. That phase is over. Kotak itself is a big bank now. So again, the point comes down to what Nuresh was saying. Given its huge underperformance, it's possible that it can outperform in the near term. But then, given that its valuations are much higher than that of most larger banks, it will be tough for it to outperform significantly. So that's what my view would be.
Okay, I'm going to shift gears completely and talk about metals. Sandeep, why are metal stocks growing higher? Is it because world is convinced that growth is back?
I think there are three factors. One, they got down so much that as the Chinese reopening story came up, the prices started moving up. Secondly, in a downturn, destocking happened, so no one was building inventories, and as soon as prices started to uptake, there's an inventory build-up cycle which starts, and that leads to prices moving up further, and that's playing out in the commodity companies. Clearly, margins seem to have bottomed out, and that is driving the stock prices. But I don't think we'll see a spiraling up move because global economies are still going to weaken, and this Chinese reopening theme will play out for some time before people realize that they are going to be in a structural downturn now for several years. And to that extent, there might still be some time to play this move in metals, but not long term, I would say.
Okay, I'm going to just go back to IT because IT has shown signs of mild outperformance, whether it is Persistent or Infosys. Nuresh, is there a trade in any of the IT stocks?
So it's a tough trade wherein one has to go contrarian here. So the contrarian trade is to start looking at stocks which have underperformed, wherein you get the whole list of small cap IT names, which is where we've seen underperformance for a long time, which is basically you go to LTTI, LTTS, LTI Mindtree, if one is looking out for an outperformance. From here on, we've seen a good bounce in TCS and Infosys in the near term. The risk reward is not great. Overall, the trend has changed. So one would, if one wants to play IT, one has to go a little aggressive, go at the smaller names, which would basically be a gamut of a basket of LTTS, LTTI, LTI Mindtree, a Birlasoft or something like that. In the large cap space, I would expect a slow and steady move. The risk reward is not great. A 5% upside and a 5% downside is what I go with at the current levels.
Right, okay. That's the take coming in on some of the active movers. Also, interestingly, while we did see a bit of a perk up coming in on IT, but yes, LTTS for instance, on Friday fell about 5%, but you had a Coforge on the same hand, which held out by about almost 4% or so. Sandeep, anything to read into the recovery in IT names, sporadically albeit, but they're making an attempt at least, or you think this is just a trading move?
I think it's mainly due to two factors. One, although the results were not as great, the outlook given by most of the companies was not as negative as what people were expecting. Secondly, in the US, inflation seems to be slowing down without a huge decline in the economic activity, at least as per the data which is available now. So maybe the interest rate hikes will impact the economic growth going forward. So I think these two factors are creating some positivity. On the flip side, the rupee depreciation aided the profitability of IT companies among potential margin pressures in 2022, given the huge depreciation of the rupee. Now that depreciation seems to be stalled as the dollar depreciates, and already in this quarter, I think the rupee is already up 2.5% and which could actually continue till March, and we could see further appreciation. So that could become another headache for IT companies. So on balance, I would say risk reward is not set such so great now for buying into IT stocks broadly across the board.
All right. Meantime, it's going to be a hectic day on the earnings calendar today as well. There's Axis Bank, but other than that, you've got the likes of Karur Vysya Bank, Gland Pharma, Root Mobile, Canara Bank, Syngene, etc. that will be coming out with their quarterly numbers. So the street will closely be eyeing this as well. Wanted to get in your take then, Sandeep, as to what exactly you'd be watching out for when it comes to an Axis Bank's numbers?
I think trend should be similar as what we've seen in other banks, where CASA ratio is high, NIM expansions to recent highs or multi-high levels, improvement in balance sheet, and I think from Axis Bank specifically, people will be looking out for some commentary on the Citibank integration, how that's going, and how much they'll be able to retain out of the clients they potentially acquired due to that acquisition, because they paid a substantial amount for that. So I think that's something which will be the more important factor for Axis Bank.
Okay, let's quickly tell you what else is happening outside the world of markets. In China has reported nearly 13,000 COVID-related deaths in hospitals between Jan 13th to 19th alone. The death toll came a week after China said that nearly 60,000 people had died with COVID in hospitals in just over a month. Also, people across China rang in the Lunar New Year on Sunday with large family gatherings and crowds visiting temples after the government lifted its strict zero COVID policy, making things even worse and marking the biggest festive celebration since the pandemic began 3 years ago. And also, 10 people are feared dead, another 10 hospitalized after a mass shooting in California. The shooting happened at a dance studio near a Lunar New Year festival celebration. Authorities have yet to reveal a possible motive for the shooting, but said that 72-year-old man who opened fire died from suicide after his vehicle was surrounded by cops. Also, federal prosecutors have seized nearly $700 million in assets from FTX founder Sam Bankman-Fried in January, largely in the form of Robinhood stock. Bankman-Fried, who has been accused of stealing billions of dollars from FTX customers to pay debts incurred by his crypto-focused hedge fund, has pleaded not guilty to fraud charges. He is scheduled to face a trial in the month of October.
Moving on, the Indian Navy is set to commission its 5th Kalvari-class submarine named Vagir today. INS Vagir has been built indigenously by Mazga Dock Shipbuilders in Mumbai. 4 Kalvari submarines have already been commissioned to the Indian Navy, while Vagir is going to be the 5th. India, meantime, crashed out of the Hockey World Cup 2023 after losing to New Zealand in a sudden death for 5 at the stadium. The teams played out a 3-3 draw at full time, taking the match into the shootout where India lost to New Zealand. And while the nation pays tribute to Netaji Subhash Chandra Bose on Parikram Divas, the Prime Minister will be participating in a ceremony to name 21 largest unnamed islands of the Andamans and Nicobar Island. They are named after the 21 Paramveer Chakra awardees, and he will also unveil the model of the National Memorial dedicated to Netaji to be built on Netaji Subhash Chandra Dweep. Moving right on, the preparations for Republic Day celebrations are on in full swing. The full dress rehearsal for the parade will be held in New Delhi from 10:30 a.m. today. It will be starting from Vijay Chowk and proceeding to Red Fort. There's elaborate traffic arrangements that have been made for the smooth conduct of the parade along the route.